1.32 versus 148 or 1,487,000. So off about 115,000, something like that. Not the worst. I don't see the stock market getting too crazy over it at the moment. Let's go to the intraday and take a peek. Let's see. I guess if the economy is slowing from housing starts, that probably freaks out the bond traders think or the stock traders think and they think, oh well, wait a second, if things are not that good, they can lower the rates. Let's lower those rates. Gotta lower those rates. We need to lower those rates. Rate cut, rate cut, rate cut. That's all it is, over and over and over again. Rate cut, rate cut, rate cut. We need lower rates. Rates, rates, rates. Spend more money. Borrow more money. It's more borrow money more than spend money. But that's all they want is lower rates. Lower rates. And you can see here when the news popped out, right? Let's see, where is it at? Let's put it up on this screen right here. You can see it popped the stock market. They were like, oof, lower rates, lower rates, lower rates. Please give us lower rates. And Mr. Powell speaks today, too. We got to put up with him rambling about whatever. And I'm sure he'll be telling us how they're going to cut rates. I don't think they're cutting them in June, though. I don't know. They're so hungry to at least start the proof of it. If they don't cut in June, it makes it hard for them to cut in July, and then they can't cut until after the election. They are starved to cut some rates. They need to cut some rates. They've been promising to cut rates, and so they need to show that they can make, as we would say around here in America, make where the rubber meets the road. And that's the starvation of it all at this point. And that's what it is. It's literally a starvation. They need to cut the rates, and they are just fighting so hard to cut those rates, and they try to find justification to cut those rates. And did I mention that they want to cut the rates? Yeah, I guess I did. All right. So anyhow, that's where they are there. Let's see what the let's take. You can see this is what happened with the. Let's just show you, because there was the fantasy right there. Oh, right there. Thinking, oh my goodness, they can cut the rates. And so let's take a look at the euro and see how the euro looks. And the euro did the same thing. It made a jump. Same way, right there. Right there, they made the jump. And so the hunger never goes away. They linger. Let's see what the bonds did. Now let's go check out the vigilantes. And that will tell us probably the same story. Yeah, it looks like it. They lifted the bond up. It was right there. The news came out right there, and they lifted it, drove it down, lifted it again, drove it down, but higher lows, and now they are, flirting still with strength, not weakness. But if you really want to look at something that really accentuates the whole story, let's show it to you. Right here is the bond, and woof, 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 woof. Look at that slide. They're trying. They are trying. It's down for the day to begin with, so it's not exactly like it's not exactly like they're buying these things. It's just a dead cat bounce. Dead cat bounce. And it's got a lot of work to do to get back up to where the 7 should be. This thing is getting uglier and uglier. Matter of fact, it's changed its whole complexion. Now it's just a downwardly slope or channel. They're not pulling punches. Now, obviously, Powell will speak today. He will tell them they're gonna do that thing with the rates. I'm tired of saying the word, but they will be doing it. He will be telling you that they're going to do it. And as I think I used as a title yesterday, something about the Fed being transitory in its concepts and ideas or something of that nature. That is where we're at this point, too. It's the same way. It's really strange. It's a definitely strange situation going on when it comes to The Fed speaking about marketplace and inflation, and then the White House talking about it. And then you look at the actual math, and it's like, well, wait a second, that doesn't make any sense. That's the problem right there. Wait a second, that doesn't make no sense. What is wrong with that picture? But that's all right. That's it's these are the buyers of last resort. They are the central bank that basically protects protects everybody. I guess some way or another. They spending money and no stopping them from spending money. That's what it really comes down to. Until we get rid of this government, this particular people in the government, and replace them with better people in the government, and that's what it really comes down to. So. Let's go over and take a look at the dollar index. Now we're getting to business. Let's check out the business. Let's go to the DX. There's the DX, and it's up from yesterday. It looks like. Let's put it up on that screen right there. Bingo, bango, bongo. Yo, Janos, is it working? The chat? Yeah, the chat's working. I see it. I see a heart there. I see it all functioning. Let me just double check my sound. Now you make me nervous. Oh yeah, I checked the sound. Sounds good. Okay. Now let's put up the dollar index here, like so. There we are. And there it is right there. You can see, okay, they're pressing down the dollar a little bit more. You see the dollar pressing down. So, let's see who is dinging here. So, what else shall we say about the dollar index? More than the fact that it's showing a little weakness, nothing major, It is, keeps on climbing and holding on to that 106 area now. Like I said, I was really surprised it got through the 105 and a half, 105 and change. I thought that was all we had in it. I figured that Mr. Powell and his mistakes would, hold it back. That's what we expected. And so at this point, we're watching we're watching a Federal Reserve that is trying to, they're the buyer of last resort. We had this conversation yesterday. They are the buyer of last resort. They are the ones that run the markets now. And, when they want it to go up, it goes up. And when they want it to go down, it goes down. And there's not much else that can go on with them. In other words, the Fed is not that interested in doing anything else but what it wants to do, what it thinks is right to do. That's what they think this is right on some level. You got to imagine that they're hooked on the drugs at this point. It's like a drug addict. They have the power of as much money as possible to straighten out anything that they're upset about, financially and the marketplace and, just all of that. So that is the unfortunate situation we're in. I can't wait to hear what Powell says today, but we know generally what he's going to say about lowering those rates. All right, let's go over to and let's look at on the beta too. You can see here on the main platform. You can see it right there. We're looking at now 5 days in a buy, very solid. We're looking at 5 weeks in a weekly buy, from the 103-ish area. So, in between 103 and 104 in that area, and now we're up into the 106 area. So, you can, I guess that it's like that old saying: you can fool some of the people some of the time, but you can't fool all the people all the time. I guess that's what it comes down to. All right, from there we're going to jump over to the euro. Let's see what the euro. And remember, traders, if you have anything you'd like to look at or look at through the eyes of our mathematics, or hear our simple opinion about them, just put it on the chat line. You don't have to say anything more than the product itself. You don't have to ask if it's going up or down. All you have to do is put it on the chat line, and we'll go after it. All right, now there is the euro. You can see the euro, it's making a nice little bounce too right there. And you see 5 days in a sell. You see 3 weeks? 4 weeks. This is the fourth week now in a sell too. The pressure is pushing on it. It's bounced off of our 0.38 area. You see that right there. The trick of using Fibonacci is to understand where to start it. That's what it comes down to. Once you understand where to start the Fibonacci and then end it, it gives you a great alignment. And today, since quantitative easing got going, there's a lot of computer programs now that will tell you, in a vacillating way or a shifting way about how to align those things. But right now, they're excited this morning. I can see the stock market now is up 272 points. So they needed to do something to get that stock market moving again in a positive way, just in case money managers figure they need to liquidate. So they got to give them better prices. One of the I was talking to Robin about this last night, and Robin was looking at it and saying, "What is up with that?" Looks like they buy them pre-market and sell them cash market. And I said, yeah, that's what it is. It's the Federal Reserve doing it and pumping the markets up. And he said, well, how do they make money doing that? Because, then they got to liquidate it again. I said, well, it's not that as much as they're trying to make sure that the mutual funds and so forth are making money, and the hedge funds and the retirement funds, because people have their retirement money in it. And a lot, there's a FINRA, it's a federal, insurance system that takes care of that. Quantitative easing was a PhD thesis for Chairman Bernanke when he was the Fed chair. That's what he got his PhD in many years ago. And so what it came down to is his PhD was in what did they do wrong in the 1930s. And so, not to make this a long, crazy story, but it all came down to the fact that equity was destroyed, not because of poor investment, but because this newly created Federal Reserve from 1913 didn't do its job in 1929 and 30. They didn't protect the banks as best as they could have. In other words, they didn't have the banking insurance that we have today. But more than that is that they could have just bought bonds in all those banks and then tightened up the banking system, and people wouldn't have lost their life savings. And that's what happened was during the Great Depression in 1929 to 1936, 1937, I guess it is. For those 8 years, there was no real protection to the investment community, and because of that, people who were just putting money in savings accounts in a bank lost it. It was all gone. And so Mr. Bernanke came up with something called quantitative easing. His theory was that if the Federal Reserve had just gone in and bought bonds from the banks that were financially in trouble and held on to those bonds for 10 or 15 years, the economy would have been growing, and then people wouldn't have lost all those assets, and then the Great Depression would have been less punishing and hurtful, and the whole bit, And so that you fast forward to 2008 when the financial system collapsed on our planet. And the major institutions like Merrill Lynch or Lloyd's of London, they all went bankrupt. And so Bear Stearns, and we go through this litany all the time about it. And so what they did is they realized that quantitative easing needed to be implemented for 2009 and 10 to try to just get everything adjusted back to normal. Okay, what they considered normal. Unfortunately, here it is, 2024 now, and the politicians won't turn it off. And so now we don't have participation by the public and the psyche of the markets. Instead, we have politicians making sure that there's a Fed put. And that's really where we sit at this point. And that's what's really harsh about this whole thing. So we look at the products live every day, and we show you, when announcements are made, how they move to the market, and the fundamentals, and what was normal is not normal anymore. But yesterday's title was "Fed is transitory every day." It really is. And so today we're having the conversation is that the Fed put, I think that's what it'll be. The Fed put is alive and well. And that's the title today. And that is the title, and that is pretty much what we're talking about here today is why do the markets seem to want to lift when the U.S. market's not open and then fall down when it is open? And that is because they're helping out the funds so that those assets are there. In other words, imagine if they didn't pop these markets up, the Dow would probably be down like another 2,000 points over the last week or 2 weeks. I guess like 3 or 4 weeks now. Let's go put a chart up of the Dow just real quick, and then we'll go back to all the currencies and so forth. If anybody wants to see anything, say it, and we'll stop what we're doing and go show it to you, and then we'll go back to this train of thought. Let's see, where's it at? Right there. Okay. So we go like that, we go like that, there's the Dow Jones Industrial Average, okay? And you can see it's come down from 40,000 down to 38,000. Imagine if they had not, over this last basically 3 weeks, and we've been in the weekly sell for 3 weeks on the Dow too at the same time. Went into the weekly sell this week right here. Let's do this. Pink and bink, a bink, a bink, a bink, a bink. And so you can see right there, this week it fell into the weekly sell, and around the 39.5 area by the close of the week, it was 39 and change, 300, something like that. And now today we even dipped below that to the 37.8. And if they didn't buy this market in the aftermarkets and pumped it back up again, institutions, retirement funds and mutual funds and so forth would be down even more, maybe twice as much down than what they are. And it's not that bad. I mean, it's only off what is it? Something like 4 or 5%. That's nothing. A crash is 7% in one part of a day or whatever. We're not even. It's slowly leaking to the point where the sell-off is not that bad. And so it just keeps on, they pump it up and then they knock it down. They pump it up and then they not let the funds knock it down. And so it's the Fed put, it's protecting them. And so that's where we are. Okay, I think I've got my point across. I think it's a good general idea. If anybody has any questions about it, just fire away. We'll answer anything. And if not, we'll go look at the rest of the currencies, get a flavor of what our math is telling you, because our math is always, relatively solid, anywhere between 86% out of 100, or sometimes it can get up into the 90s, and sometimes it can get down into the low 80s. But overall, it wins almost a little more than 8 times out of 10. It has the right direction. And when you're using listed options, it can be even more profitable. So, or good stops, good as Robin would say, good trading tools. So let's go back to Let's go back to where are we going back to? We're going back to the currencies, and there it is right there. You see the euro, and like we said, 4 weeks in a sell and last 5 days, and it is giving us a dead cat bounce right there. You see the little green and red dot showing chances of some action. All right, from there we slide over to the British pound. Now the British pound doesn't seem to be getting as beat up as the euro. You can see it's hanging around this 0.23 area on the Fibonacci line, bouncing around it. It is not challenging the 3.8 like the euro is. It also has been in a daily sell now for 5 days. You see it right there. Let's widen this out if we can do so, like so. You see it's been in that sell there. And at the same time, it's in a weekly sell now for going on the 4th week. So it's also, feeling pressure. And what we can do is we can show you the difference with the Euro GBP pairs trade right there, where it's been in a sell for 6 days now. And it's climbing into the weekly as we speak right there. You see that right there. So there is some pressure. I don't believe we're going to see that big of action. I just don't see that. I see, markets, are more in a sideways channel now, whereas we see the bond market obviously not in a sideways channel. It's it's a sloping down channel. They are not the happiest about the. They're just not that happy with the price of the bonds. They think that they need to be the interest rates need to be higher. There's a good amount of economists that I trust that have been accurate. We talked about this a couple of days ago. I trust only economists that have long track records of being accurate. In other words, when they start losing their accuracy, they have to. Then I don't pay attention to them anymore. But most of them have been very accurate for a very long time, and we've conveyed their general trend, and we've been right. We've been telling you that there wasn't going to be 7 cuts. More than likely, there weren't even going to be 3 cuts, and now we're at a point now where they're probably going to give us a 1 cut, possibly somewhere around. They have to do it in the next 2 months, and if they don't do it in June, July, then it's going to be a real problem. They're not going to be able to cut until after the election, and I think that they need the president and his party need something to show the people that they're not totally 100% incompetent. So it's going to be a real pressure cooker for the Fed chairman to not lower the rate by a 1/4 percentage point somewhere. All right, from there we'll go over to the Swiss, as I like to call them, the great inflation fighters. They're doing a good job, and you can see we've been in daily buy here for 6, 7. This is the 7th day. We've been in a weekly buy. You can see this all the way back in here since the 86, high 85 area, 85 and change, high change and lows. Let's see. Oh, Yana says maybe, let's see. I just saw Yana's message. Let's see where it's at. I just saw your message jump up. Let's see where it is. There it is. You've had let's see. What did you enter credentials? System shows you as a Swiss citizen account to set never expire. What? Bonds read the right direction. What did I just see? Something popped up. Giannis, didn't you just text me? I'm confused. Yeah. Didn't you just text me? I think you did. I'm just going to say hi. See if that's where you texted me. You texted me somewhere. Oh, okay, there it is. I see where it is. It's up. It's on the Dukascopy host. Is that it? Yeah, Doc, you have had that title a couple of times. Maybe phrase it differently, more catching. Shocking. Federal Reserve pushes market up. Fed is manipulating the market. Don't worry, Fed will buy your shit. I like that last one. Oh my God, the last one's good. Don't worry, Fed will buy your shit. That's too good. Oh my God, that's too good. All right, I'll come up with a better one. Something that's somewhat shocking, but definitely sound like from a gentleman from a hedge fund. How's that? We'll come up with something like that. Let's see. All right, yeah. I'll come up with something. I'm still laughing. I got to calm down on that one. That is too good. Oh my God, that's too good. Yeah, I see them. I see the messages now. They're great. Oh my God, great. Oh my God. They're great. Yep. Oh my God, that's too good. That's too good. I'm still laughing. All right. So what stock can one add to a portfolio to hold the next 2 years? Next 2 years. Let's see. I've had my eye out on it yesterday. I was trying to put something together throughout the day. I'm still working on it. I'm putting a group together because you want a nice long term, and I got to dodge the. This is with Trump winning the election, and so it'll be infrastructure. It'll be industrial. It'll be a lot of good ones. It'll be fun. I'm going to come up with 5 to 10 stocks I'm working on right now, trying to chart the course for them. I will come up with something. I definitely will. Like I said, I was working on it a little bit yesterday, and I will keep on working on it. And over the next couple of days, we'll come up with something that will identify 5 to 10 different companies that have great potential if Mr. Trump wins the election. I will definitely do that. All right. So from there, I'm still laughing from your statements. Let's see. Let's go over to the yen. Let's see what the yen is up to. There's the yen. Ooh. Looks like whatever they're thinking about supporting at 152 doesn't seem to be happening whatsoever. It's now in the 154.60 area. So the yen is still marching north. It's been in a daily buy now for 8 days and a combination of 5 weeks. So yow. And it seems to be at the high of the day now. I guess no choice but to. Okay. And so, the yen. They claimed, the Bank of Japan said they were going to do something about 152, and it lasted for about 3-4 weeks there. You can see it right here. I'll put a little square around it. So when it got up into this area here, they had made it clear that they were going to defend it right there, and they did for, I guess, about 3 weeks. But it seems to have failed. They need to watch the Dukascopy webinar to get a little better insight into markets. We can give them better hints. But yeah, that is turning into a real tough situation for them. But it's not going to go all turkey on them, so that's okay. I mean, you're not going to see like 2.54 out of nowhere and 3.54. And we usually go to the great experiment right afterwards, right here. Where this product can go up 2 or 3 handles in a day with no problem whatsoever, move up hundreds of points in a given day with up and down and sideways and so forth. And you can see, since whatever they thought they were going to do here, it has been in a sell now for 5 days. But the weekly is not joining in with that action. It really doesn't think that there's they don't really think that whatever the government is suggesting or trying to help or try to finance, it doesn't seem to be happening. I loved it when they came up with the idea of giving free puts to currency investors, but they put a rule on it that didn't make it blanket. So when they didn't give a blanket protection to everybody, the currency went from the 19s to the 35s, which is pretty damaging. So that's where we're at the moment. And so then from there, we're getting closer to the open, and the stock market is backing off already. Can't they hold it up at least until the market opens, cash market opens? Jeez. All right. Let me just show you what we're looking at real quick there. We'll come back to the currencies in a second. And let's see, intraday, right? Yeah, intraday, there it is. And here's the S&P 500. And you can see this was when the news came out and everybody had hope. They had hope for a few minutes there that rates would be cut right there. But it's I guess if they make if they don't, obviously this is the low of the low for months now, but if they don't take out this low, maybe they'll bounce back up again. So this is just a digestion, a consolidation, and maybe another pop. And if they don't, and they take out this low, then you got to be consumed about the idea that they may take out this, and then everybody's going to be staring. Everybody's going to be staring at. There's money managers are now staring at the 5,000 area. It's at 5,109. They're looking at they're thinking deeply about 4,800, 4,900. They're going to be buying with both fists. They're going to be reaching in, buying everything and anything. They're all convinced that they can. The Fed is going to protect the 4,800 area. So that this, I would think there'll be a second bounce and they'll try to go after the highs, and we'll see what goes on. But that's the stock market right now. It's not looking that bad. It's just that they're giving up some of this nice gain right here, and they already knew right there. You can see they front run the markets. They knew a couple hours ago that was in there. They let their friends know, family and friends operation. That's the way this government works now. They're into fattening their wallets. All right, now let's go back to the currencies, and we were looking at the Turkish lira, and nothing going on there but 32 weeks of a weekly buy. I'm heading for 2/3 of a year now, and we're in 5 days of a sell. So I don't know if they're trying to fatten their wallets too by, swinging it out wild and woolly. Last but least, the last of the currencies that we follow is the South African rand. You can see the triangle that it's been trapped in for a while. It doesn't seem to be marching along with the metals whatsoever anymore. It's been going up for like 6 days now. It's been in a buy since right there. And last 6 days, there's no doubt that the metals market, we'll show you the metals market right here. The metals market has been, sideways. You can see it there. It's been sideways. Got a lot of red dots going on inside of it. It's trying to go down, but it doesn't do too good a job. It's been in the daily sell from here, and to a great extent, it keeps on coming back to it each day, and then lifts back up. So the Fed is not that interested in seeing a high-priced gold. They don't like gold being high-priced because money managers have it written in their incorporation manifesto that they have to, do something with their stocks, like sell them, and pick up more metals. And they don't, the Federal Reserve is not happy about that. They really want to. They really want the gold market to go down more than up, but obviously people are frustrated and they, people are concerned and they don't see a lot of positiveness, and so they're reaching for the gold. I heard a debate yesterday. It was the wildest thing. It was around the last hour of the trading day between two money managers. One trades gold, the other one trades cryptos. And they were, who is the better product and what's the better product and why is it the better product? Fascinating. And, the crypto one had a lot more better to say because, we all know it was a woman and then the money manager was a guy. Both of them, the gold guy was, the gold trader was a guy. And it really turned into an interesting battle. I mean, it was really, that that's that really was a surprise, uh, and she had all the things we talk about in her toolbox, I guess you could say. She said, "Hey, you know, the Federal Reserve can cut off your gold, and you can't even take delivery at times, but they can't interfere in your cryptocurrency. You can take delivery whenever." So, she was saying, and he was saying, "Oh, well, all right, but right now gold is up and cryptos are down." And she was like, "Yeah, that's the way it is. It's a free market." See, people have forgotten what free markets look like anymore. Free markets swing back and forth. That's a natural thing to them. And so it's not, it's free markets are volatile. And if you've noticed, the people in the media, when they talk about the markets, if it's down a half a percentage point, it's a crash. Markets down a quarter percentage point, it's a crash. It's like, what? Markets normally swing quarter, half, so forth. Ever since the creation of listed options, they've opened the marketplace up to great trading and great maneuverability of equities. And, now we trade 1 billion shares or 2 billion shares or 3 billion shares in a day. It used to be where they traded 3 million shares a day. I remember when I would walk from the subway with some of the old traders, and they would look up and they go, I made more money when we traded 3 million shares, and now we're trading 150 million shares, and it's nowhere near. I worked at the New York Stock Exchange when they traded 80 and 90 million shares and 70 million shares. Now, they trade 1 billion shares in a day. And the floor traders used to say, "Oh, we made a hell of a lot more money when they traded, the smaller amount, not the larger amount." But when you have a world flooded with cash by the central banks over the decades now, our money supply keeps on going up, and when you have that, it opens the doorway. And now, can you imagine, like BlackRock or something like that has what crazy number, like 9 trillion under management? 9 trillion, not billion. I remember when billions were a big number, where people thought, "Oh my God, trillions, billions," and then millions were like a norm. So it's we are in a very great distortion, and I would say that if you follow cryptocurrency, that's what free markets look like. And when you follow listed markets with the Federal Reserve in control, that's what gives us all this deficit, because they're borrowing money to keep the markets in line so that they don't have to take responsibility. That's the key word right there. Fed and its responsibility. Let's try that, Janos. There we go. Now we can go with another one. There you go. Feds lack Fed stops free markets. How's that? Fed stops free markets. That's a good title. Is that it? Did I get it in the right spot? I think I did, yeah. And when you want to compare free markets and how they look, just watch the cryptocurrencies compared to, or oil markets. Oil markets, they have a hard time controlling oil markets too. Even with Mr. Biden taking 130, or was it about 130 million barrels from our strategic reserves, he still can't control the oil markets that well. And that's what free markets look like. Watch the currency markets. Currency markets, to a great extent, trade like free markets. Bond markets totally trade like free markets. They really have a hard time influencing the bond market, the Federal Reserve. They'll go their own way. You got to imagine. Let's just put that up on the screen for a perfect example. There's a perfect example Where's it at? Right here, and we'll go through the metals market again in a few seconds. But there's a perfect example of a free market right there. The Fed wants to lower rates, and this thing is in a downwardly slope. Remember, when a bond goes down in price, interest rates are rising. See, like right here, when the bond price, you're looking at the price of the bond. They're trading the price of the bond over here. When the bond price goes up, interest rates drop, and then interest rates went up. Interest rates went down, and now interest rates are at like 6 months or maybe like 3 years. I'm not sure if we're way out or not, but I know we're close to it. We're at something like 10-year highs or something like that in interest rates, something in that range. So it could be even. You know what? It could be even worse. Let's go over to. Let's see if I can put it up on here. Let's do this. Let's take a look at the bond for the last 20 years. Let's see. Since 2008 to now, what is that? 10? That's 16 years. So let's look at the bond, 16 years. It was still gliding down. Okay? The interest rates were going down, and down. And then, under Mr. Obama, with the quantitative easing, he kept them so low for so long. And remember, he had that crazy magic wand story. He told Trump, it'll never work for you. You don't have a magic wand. And then Mr. Trump turned around and proved him wrong, and he does have a magic wand. And let's see, here we go right here. And let's just take a quick look of the bond market. Let's see, what is it? Let me go back and look at it real quick. It's B. That's dollar index. Let's see. There it is. ZBF. That's what it is. ZBF. Okay, so let's put this up there. ZBF equals F. Go like that. And there we go. Now we're going to put this up on the screen. Let's see. Oh, there we are. Okay. And let's put it up on the screen here. And you'll be able to see this. All right. That's the bond market all the way back to 2006. What is that? That is 2005. I'm sorry. There's 2005. This is the beginning of quantitative easing. Remember, price rise, interest rates drop, and that's what they did. They fought, and you can see it ebb and flowed. And now, since 2000, at the end of 2020, going into 21, Mr. Trump left and Mr. Biden came in, and you can see interest rates have been rising. It's just policies, not much more than that. But the bond traders, or as the Fed likes to call them, the bond vigilantes, basically are not interested. And now we're at interest rate. We haven't seen these type of interest rates since 2000. What is that? 2004, 2005. It's been a while, and so that just shows you this is what a real free market looks like. All right, and there it is there now, just up on the bond market as we speak. And then from there, we go over to, let's go back to the metals, get the metals put to bed. And there is, we saw gold. Gold is flattish, trying to go down a little bit. It's a little under the 2400 area. It's at 2390. Still in the sell, but in a weekly buy, so you would not take a short in there. All you're doing is standing to the side or neutral. Silver, same situation. They're selling it off a little bit, but it's been up to the $30 area now, so not bad from 22. We went into the weekly buy around 22 and a quarter, and it got up to 30, so that's pretty cool. Copper, interesting how copper is fighting to rise. They're really hoping that China is going to find a way to get their act together. You know, the numbers today were not pretty. Their stock markets were all down. They're just not growing because we're not growing. You know, if we're not growing, they're not growing. That's pretty much the way it goes. Platinum, the most dangerous short in the world as far as I can tell. You know, it's trying to go into a sell today. It's in a weekly buy still. It did get to the $1,000 mark and jumped across, but it's so undervalued compared to gold now. You know, it's a dangerous thing to try to short. All right, now let's go over to the crude oil market. There's crude. U.S. crude has been sideways with all the noise in the Middle East. And let's go over to our beta platform again and show you the metals like, not the metals, there's crude the same way. And you can see they've been in weekly buys, but daily sells for days and days and days. You know, 6 days of selling going on there. Then we go over to Brent. Here's Brent right there. Brent's been having that same issue. It seems to be trapped. I've heard some oil traders talk about Brent saying it doesn't look like it can get through the 90s very well. In other words, it's not going to go to 100. I don't know. I guess it all depends on the geopolitics. One thing is for sure, and that is that energy prices are going to stay pretty firm now for the next few months, I would imagine, especially with the summer season coming on. I was looking at the, maybe I'll show it to you. See if we can show it to you. Check this out. This is the oil market right here. And check these prices out. I was looking at heating oil, and I was thinking, you know, is heating oil, what's it look, you know, what do the back months look like? That's what I was thinking. I was thinking, what do the back months look like? Look at this. This is the back months. Here is March is it March? No, I'm sorry, May. This is May of this year. 260, 2.6437 a gallon, okay? And it goes all the way out to March of 25. You know, whole year it's in the 260s. And it's actually contangoed in a negative in some spots. You know, interesting. You know, I would have thought that it would have been a lot more higher in prices. And you can see the further you go out, the price actually drops because of the cost to carry. So the energy market is not that freaked out. You know, they're looking forward to better prices in the future, which I'm trying to calculate for the 5 or 10 stocks we're going to try to look at that would be great for the next 2 years. From there, we'll go to natural gas. There's nat gas. And because of all the drilling that's going on, it makes natural gas here in the States cheaper because it's a byproduct. And so it's, you know, it's backing off from it, that type of thing. Let's see, what else we got going on there? I guess to a great extent, we finish off with the Spanish energy company. It's one of the only ways we can see what the prices in Europe are. And the stock's been trading just underneath the 21 area. Whoa, look at that. They jacked it. They're getting nervous. Look at it, almost got to 23. It's up almost above 22. It got through it and then back down. We've been in a buy for 3 days, so 4 days, I'm sorry. 4 days we've been in a buy. So, you know, it went into the buy here and has lifted and carried all the way up. The weekly went into the weekly buy last week. And no, it started, went into the weekly buy last week. That's what it is. And so it's been jacking up and there's been pressure on it. And it's not going to change any, I guess. I guess they're getting nervous about energy supplies. So it's we weren't expecting that. I was expecting, you know, like 20 and a half. You know, you can see maybe close to 21 like it has been the last couple of days. Didn't expect to see almost a run towards the 23. And to be exact, let's make it bigger. So you can see here it got up to 2250, a little above that. What's the exact number? 2260. So it got up to 2260. And it's been in, I guess is that 5 days? It's 5 days in a daily buy. And it's not showing today's. And with that strength in there today, it's definitely higher. And so That is the action we're seeing in the energy market there. All right, let's just give you a flash look at there's the Nikkei. The Nikkei's, like a 3-week low or 4-week low. It's moving down to the 30. Is it the 38,000? I guess it's heading towards that. It's been in a sell for weeks. Weekly sell for 3 full weeks, going on a 4th week. We can take a look at the Hang Seng. Let's see what see, where's the Hang Seng? Right there. The Chinese market, since the economic news is definitely having its issues. You can see the last couple of days it's been pressing down. Went into the sell, almost went into the sell yesterday, but it's been breaking down. Curious, it was riding the buy again. They were trying to come up in here. This thing's off 50% from its all-time high, so it's not exactly the best. And you can see the last 3 out of 4 weeks has been in weekly sells. Let's take a look at the Taiwanese, the Taipei. You see that's still staying in its buy and just rolled over today. Just rolled over today, but still in weekly buys and all. And then let's go take a look at the Nifty 50 right there. And that's been in a sell mostly for the last week, but it went into a weekly sell a week back and then jumped into the weekly buy last week. So let's see if this thing turns around. You see it last bunch of days it's been in a sell with the red dots and the histogram underneath over the last 5 days, so it's been pressured since here. And then let's see what else we got going on. I guess that's let's see what the FTSE. Let's see the DATs in the FTSE. There's the FTSE. They're slamming that today too. And then let's see the DAX. There's the DAX. DAX has been in a glide for a while. You can see it right there. You see the weeklies. I mean, that's the daily algorithm. Just since the, what is that, the 2nd? It's been in a sell since the 2nd, since up in here. So it's been in a sell there. It's been gliding down. So we got a lot of pressure going on in these products. I'm not sure the ECB does as good a job of holding the markets up for their players. All right, traders, we're out of here. This is Doc from North America. We will catch you all tomorrow, same time, same channel. So tomorrow will be Happy Hump Day. So happy trails to you until we meet again tomorrow. Happy trails to you, to all our trading friends. Later.